Most investors do not fail because they choose the wrong ETFs. They fail because they invest without a proven process. Markets move unpredictably in the short term. Emotions amplify that uncertainty. Without a clear method, investors hesitate, panic, or abandon their plan at the wrong moment. This is why having a proven investing method matters. Not because it guarantees higher returns, but because it removes decision-making when emotions are strongest. In the last video, I explained how to build a simple ETF portfolio for European investors. Once that portfolio is in place, the next question becomes how to invest into it over time. This video explains the two main approaches, dollar cost averaging and lump sum investing, and why, in practice, I prefer dollar cost averaging for most investors. Dollar cost averaging means investing a fixed amount of money at regular intervals. For example, every month. The key idea is consistency. You invest regardless of market conditions. You do not try to time the market. You follow a predefined schedule. Sometimes you invest when prices are high. Sometimes you invest when prices are low. Over time, this smooths out your average entry price. More importantly, it removes emotional decision-making. The investment happens automatically. No judgment is required in the moment. Lump sum investing means investing a large amount of money all at once. This could be savings, an inheritance, or proceeds from selling another asset. From a purely mathematical perspective, lump sum investing often has higher expected returns. Research published by institutions such as Morgan Stanley supports this conclusion. That's because markets tend to rise over time. Investing earlier gives money more time to compound. However, this advantage exists mainly on paper. In reality, investors experience uncertainty, fear, and regret, especially when a large amount of money is invested at once. If markets fall shortly after a lump sum investment, many investors panic. Some stop investing altogether, others sell at exactly the wrong time. At that point, the theoretical advantage described in the research disappears. Not because the math is wrong, but because human behavior interferes with the strategy. This is why, in practice, the best investing method is not only about expected returns, but about choosing an approach that can be followed consistently over time. Both methods are well researched. Both are valid. The difference is not intelligence. The difference is behavior. Most investors do not struggle with spreadsheets. They struggle with volatility. A method that looks optimal but causes stress often leads to bad decisions. A method that feels manageable encourages consistency. Consistency is what compounds wealth over decades. For most investors, dollar cost averaging is easier to maintain. That matters more than marginal differences in expected return. With DCA, you never face the pressure of choosing the perfect moment. You never need to decide whether markets are too high or too low. You simply follow the plan. This reduces anxiety. It reduces second guessing. It increases the likelihood that you stay invested during market downturns. Over a 20 to 30-year horizon, staying invested is far more important than timing the entry perfectly. Lump sum investing maximizes expected returns if you can tolerate volatility perfectly. Most people cannot. Dollar cost averaging slightly reduces expected returns in theory, but significantly increases the chance that the plan is actually followed. In practice, the best strategy is the one you can execute without emotional stress. That is why many long-term investors choose DCA, even when they understand the mathematics behind lump sum investing. This does not mean lump sum investing is wrong. If someone has a very high risk tolerance, a stable income, and strong emotional discipline, lump sum investing can be appropriate. However, for most investors, especially beginners, dollar cost averaging provides structure, discipline, and peace of mind. It turns investing into a habit rather than a decision. When combined with a simple ETF portfolio, dollar cost averaging becomes very powerful. You invest into the same ETFs every month. You rebalance occasionally if needed. You ignore short-term noise. This keeps the entire process simple, predictable, and realistic over decades. Successful investing is not about doing everything perfectly. It is about avoiding mistakes that cause you to quit. A proven method reduces emotional friction. Dollar cost averaging does exactly that. In future videos, I'll continue breaking down practical investing topics step by step, with a focus on simple ETF strategies that work for European investors. If that's useful to you, you're welcome to subscribe.